Welcome everyone to the first half of 2026 Market Pulse, where we break down what's happening in the market and the economy and how that affects client portfolio. Today is Friday, January 16th, 2026, and I'm excited to be joined by Chintan Desai of Vanguard. Chintan is an investment consultant and CFA charter holder with Vanguard's financial advisor, portfolio analytics, and consulting team. His work centers around portfolio analysis and sharing Vanguard's market sentiment. Prior to joining Vanguard in 2018, Chintan worked in investment banking and in equity research at UBS. Given his wide range of experience in both portfolio analysis and different market segments, we thought he'd be a great guest to join us this morning and cut through all of the noise and headlines and get down to what really matters when it comes to clients' portfolios. So Chintan, welcome. We're thrilled to have you, and I'm really looking forward to this conversation.
Me too. Thank you for having me.
So it feels like we're picking up right where we left off, right, in 2025, if you look at the first 11 trading days of this year. And I promise that we're going to get into the outlook and positioning, but first, I think it would be prudent, right, if we took a step back and reviewed what happened in 2025, because it was eventful, to say the least. Right, we had plenty of headline news. People forget, but we had that intra-year drawdown in the S&P 500 of around 19% in the first half of the year. Plenty of debate in regards to where interest rates should be, and no shortage of geopolitical noise with that. But despite all of it, right, the equity investor that stayed disciplined and stayed invested, they were rewarded at the end of the year, and the market stuck through. So my first question to you is, if you had to break down or highlight 2 to 3 market drivers that really drove the end of the year returns that we saw, what would you point those to be in 2025?
Yeah, no, great question. I love looking back in 2025 because I think there are a lot of important lessons to draw upon that and how that sets us up into 2026 and going forward. But the one thing I would say is 2025 was absolutely a remarkably eventful year. You touched on it, right? The questions around tariffs, Fed independence, ongoing impact of AI. These are all, in my opinion, I think the main drivers of what we saw in 2025, which caused so much volatility and uncertainty. And to your point, markets still reward investors who stay disciplined, which is a foundational principle that Vanguard has when it thinks about investing. But I would say the overarching lesson, though, just maybe zoom out a little bit, was just, hey, the power of diversification and discipline. So we saw 2 asset classes that in many instances were left for dead by a lot of investors, right? International equities and fixed income. And those 2 asset classes played a very crucial role in 2025. If you looked at a globally diversified 60-40 mix, the year ended with really strong returns. We're talking about 16% returns on a 60-40 portfolio, which is quite impressive, and kept up with U.S. equities, but it was able to do it in a way where you got such a smoother ride and helped people, right, ride out that volatility that we saw in 2025. And so the main message here is it's important to stay the course and just remaining broadly diversified, because as 2025 showed us, a lot of different things were in and out of favor at various points in time of the year.
Yeah, and I think that's a good segue, right, as we set the foundation and head into 2026. And a lot of the news articles and what we're reading, right, it seems like a lot of the same narrative of 2025, right? It's AI, it's inflation, is the labor market cooling, what's happening with the Fed and independence. So what can we decipher is different, if anything, as we look into 26 as compared to 2025?
Yeah, I would say a lot of the themes are very similar. AI, policy, inflation, geopolitics. But I think the setup's a little bit different than what we had heading into 2025. When we think about the drivers of short-term outlook, capital investment still remains a pretty strong growth engine, largely driven by the AI spending. But what we would say is we're still in the relatively early innings there, and we can touch on that a little bit later. The other thing I would hit on is inflation. Inflation should moderate. There's a lot of I would say, uncertainty around like the impact of tariffs. And, we've had a full year to start to digest like what those impacts could look like. And so we do expect a little bit of like a creep up inflation, probably in some point in the early to middle part of the year, before it starts to come back down again. And then you're right in terms of like the labor market. The labor market, if we think about it, end of 2024, like 200,000 jobs were being created, and by the end of last year, we're like that's dropped down to 50,000. But our overall view is we still believe the labor market's going to remain resilient, and our expectation for unemployment by the end of the year is going to be around 4.2%. So still a really strong, healthy labor market. And unlike what we were anticipating in 25 in terms of like Fed rate cuts, we think the Fed is going to be a lot more patient this year. We think our expectation is potentially one cut this year in the early half of the year, and any further cut is really a high bar, just because of the sticky inflation that we're experiencing and just how strong the market has been overall. So we just don't think there's going to be a lot to compel them to cut further outside of maybe some political noise that's been out there.
Yeah, and those are great points. And one I want to dig a little deeper on because it's something that we're hearing a lot from clients, and I want to make sure that we touch on it. And it goes along the lines of, okay, yeah, Dede, the markets have been great, but they feel stretched and they feel, the valuations look high. And my day-to-day, living costs still seem higher than they historically have been, right? From the inflation front. And if you take a step back in our seat and we look at the data behind it, and the data kind of supports this narrative, right? So we've had an unprecedented 3 back-to-back years of double-digit equity returns, right? But the latest University of Michigan consumer sentiment, the initial report that just came out last week for this January, came in at 54. And for our listeners to put that into perspective, right, the long-term average is somewhere around 80. So that's, signaling some low consumer confidence. So, you would expect after 3 years of really strong equity markets that consumers would, be sentiment would be high, but that's not the case. So my question is, what do you think is causing this divergence, right, between what's actually happening in Wall Street and, these equity returns and what consumers are feeling on the street themselves? And what would you tell a client that's looking to deploy capital that thinks the market is expensive, right? These valuations are high and optimism is low on the street today?
Yeah, great question. I think 2025 summed this up really well. Like we saw two asset classes, gold and equities, rally together, which is highly unusual. Typically, it's a sign that investors are balancing optimism about innovation and AI with some concerns around deficits, inflation, geopolitical risk. And so what we've seen is like a bifurcated market. And from Vanguard's point of view, we think the end story here is really this tug and war between like AI and deficits and what is ultimately going to play out in the long term. And if we go through this scenario where like, hey, we believe that AI is transformative, which that is like Vanguard's base case. We believe that AI will be transformative. We believe like the benefit should broaden beyond just a narrow set of like mega cap names. And if you take it to the flip side, if AI disappoints, well, like the part of the market that's really the most exposed to that, where some may argue things are priced for perfection, is really going to be like that mega cap portion of the market. So what does that mean in terms of what investors should be thinking about? Well, I think end of the day, like all roads more or less lead to leaning in your portfolios a little bit more towards value, making sure you have international equities in your portfolio, and then lean into high quality fixed income. Like that, those are the three areas that like when Vanguard's thinking about its outlook longer term over the next 10 years, like those are the things that we think that investors are going to benefit materially from in terms of making sure they've got some meaningful exposure to those categories.
that there's a lot of great points there, and I want to hit on a few of them. So,
Yeah,
right, if we
definitely.
look at, and we couldn't agree more, and as we've continued to talk about, like 2025 is the perfect example as to why the diversification matters, right? So let's take the first piece of the puzzle where you say AI being transformative, right? And
Yeah.
I think early on you had mentioned that you still believe we're kind of in some of these earlier innings, and the questions that we get from clients often are, Dede, is this AI boom sustainable? Am I late? Am I really supposed to buy in at these levels that we've already seen from, some of these big names, the NVIDIAs of the world and things like that? And to your point, right, how does it broaden down to other names in the market? So first question is, for someone that hasn't yet been exposed to some of those AI names, is it too late, or do you still say, okay, we're in the early innings and there's still room to run there? That's first and foremost. And then I think you've already answered, the second part of where else is Vanguard seeing, not just in 26, but if we were to look at, the next 3 to 5 years, there's more opportunity within the market outside of, the Mag 7 and AI that's really led the past, 3 years in regards to the double-digit returns that we've seen. So first,
Yeah.
where are we in regards to the AI, cycle? Is it too late? And how should investors be thinking about deploying capital there?
Yeah, it's a great question. I think a lot of times I get this question, which is, hey, like, is this 1999 all over again? And I think Vanguard's view is, if we look at where we are from like the capex build out cycle, which is in our view like a great way to just measure like how far along are we into the cycle? Is the cycle like maturing, or are we still in the early phases? I'm going to share a quick visual because I think it's really helpful. Like when we go back in time and we look at a lot of different capex build out, whether that was post World War II or whether that was like the railroads or telecom, what we see is like these cycles, generally from a capex perspective, have taken probably about 4 to 6 years. So probably like a 5 year nice sweet spot in the middle. And we're still only in like year like 2.5. So what that means is we think there's a lot of potential for capex to continue to be spent, and we think that's going to be a driver going forward. And we a lot of times people like to talk about valuations, and a lot of our outlook is predicated on valuations, particularly in the long term. But valuations is really a very poor timing mechanism. Like it does not mean, hey, because Vanguard likes value and we like international equities, that like those are the things that we expect to perform well in 2026. Like that may be the case, but what we tend to find and throughout history is the momentum that we're seeing in the market can definitely run in the short term. We saw this play out if you go back to say the dot-com era. Alan Greenspan had his famous speech that talked about irrational exuberance at the end of 1996, and there's all this concern around valuations back then as well. But like the dot-com didn't really happen until another like 3 years later, and what we saw the equity markets do was essentially double over that time period. And so I think, for someone who's like, hey, did I miss the boat on it? Our view would be like, no, not necessarily, but you also just want to be really mindful in the long term of like what you are paying for things. And our view is history has shown this out, and our chief economist has written a book on this. When we see big technological changes happening in the economy, what tends to happen is the market overvalues who they think is going to be the immediate beneficiaries of these technologies. And what it fails to appreciate is if this really is going to be transformative, other parts of the market are going to benefit from this technology as well. So things like value, which has been beaten up for a little while, or international, which has underperformed the US market for quite some time. Those are parts of the market where there's absolutely no AI hype. But I think it's silly to think that like AI is not going to impact some of these sectors, which can help improve their efficiency and productivity. So that's why like Vanguard's view is like all roads sort of lean back to value and international, because if AI performs well, those parts of the markets will really do well. But then if it doesn't, well, you don't get that big drop off like you would expect from maybe like the large cap growth portion of the market where everything more or less seems priced to perfection going forward.
And I think one thing that would be interesting for some of our listeners to hear about on the AI side of, it being in the earlier stages, and there's still a lot of, room to run here on this, is that CapEx spending, right? And your AI big names are just starting to get into the debt market and raise capital that way, which I think is a big differentiator, right? From when we're looking at, the dot-com bubble and what happened in 99.
Absolutely. Like I would say there's some other big differences. Just the profitability of what we're seeing now versus what we would see during the dot-com era. Like if you look over the last few years, and 2025 is a great example of this as well, is a lot of the appreciation that you're seeing for like what you would deem AI oriented companies isn't necessarily driven by valuations expanding. It's actually been supported by a lot of earnings growth. Like let's just like if you took a snapshot of like valuations at the start of 25 and you looked at it at the end of 25, valuations actually remained unchanged from the start into the end. But you saw equity markets rally, 17%, and a lot of that was underpinned by the earnings growth that we've seen, which really wasn't the case when we look back during the dot-com era. So I would say that's a big difference. But also, a lot of times, particularly last year, you've heard a lot of concerns around like vendor debt financing and some of the circularity of these deals. And I would say because you had companies that just didn't have strong balance sheets or were unprofitable, they were still dependent on that. Now, if we look at like the current setup, if you think of the AI hyperscalers, where I'm showing a visual, we're looking at like the projected CapEx spend. So just looking at from like the beginning of 2025 to end of 2027, like those AI hyperscalers were projected to, invest 2.1 trillion. But in terms of like what the expectation is in terms of the cash flow that these companies are expected to generate, even net of buybacks, is going to be well above the CapEx spend. So all this is saying is these companies are in a lot stronger positions fundamentally and don't need to rely on so much on the financing market. But you're right, like they are starting to tap the debt markets a bit more, but our view would be they've got really strong balance sheets to support a lot of that financing. So it's like some of the four most dangerous words in finance is like this time is different. I think it's more like, hey, there's like, hey, history may rhyme, but very rarely does it repeat in sort of the same manner. So I think there's some things that are fundamentally different, but like the overall narrative around valuations is definitely something that investors should keep in mind going forward.
Yeah, and I think this is a very telling chart, and it just gets back down right to finance 101 and cash flow fundamentals. And in this AI regime, there's going to be winners and there's certainly going to be losers too along the way. So we could probably have our own webinars solely just on AI, but I want to make sure that we touch on the other side of the balance sheet as well, and that's fixed income, right? Because I think that is going to have a lot of play as we look into 2026 and matters with a lot of the headlines that you're seeing, right? When you think about fixed income, you're thinking about the Fed, you're thinking about interest rates, and you're thinking about inflation. And all of that's timely as we look into 2026, right? Are we potentially going to have a new, Fed chair, and what does the independence look like? As you talked about earlier, what is the stickiness of the inflation, and parts of the market still look pretty sticky on the inflation front, and is the labor market starting to cool. All of that ties into what happens on the short end of the curve and the Fed rates, and you talked about the outlook of potentially one rate cut. So I think what would be easy for our listeners is if we broke down the yield curve into three segments, right? The short term, intermediate, and long term. If we start on the short of the curve, cash, right, over the past, call it 5 years, sitting in money market earning 4 to 5% has been pretty easy, and I think we're starting to see that narrative change, right? We've already started to see these rate cuts and projected more here into 26. So my first question is how should investors now be thinking about cash? Because I think it's a lot different. The money's not as easy as it's been over the last 5 years sitting there getting 4 to 5%. That dynamic's going to start changing in clients' portfolios.
Yeah, no, great point. And our view is like cash absolutely has a role in a portfolio. We would really view it more around really serving the liquidity needs for clients, particularly in the near term. So if there's particular expenditures that they are thinking of, whether it's saving up for a down payment on a house or thinking about some near-term like retirement needs, like having cash in the portfolio is really important to help serve those needs. Now, I think where and this is where like every client situation is gonna be really different. But like over the long term, like hey, cash can be a drag. And you raise the point around reinvestment risk. If interest rates are going low, like hey, like that cash probably no longer as attractive as it once was. And so like what do you do in those instances? I think what's really interesting is a lot of times people talk about like Fed cuts and like what that impact would be to the stock market. And I think it's less about like the Fed cuts in of themselves, but it's more about like what's the reasoning behind the Fed cuts. So if you think about a situation where hey, we're in a strong growth environment and earnings are really strong, like unemployment is really doing well, cutting interest rates in that type of environment is like adding an accelerant to a fire that's already existing. And I think you can potentially run into a situation where you're worried about maybe inflation potentially creeping back in. So like you would still expect the market equity returns to do really well in that type of environment. But now if we're talking about like rate cuts, because all of a sudden maybe the AI optimism fades and the labor market softens more than expected, like the equity markets are going to behave very differently. And so in my opinion, it's less about like cuts and what that means, and it's more about like the context behind those cuts that I think is probably more important.
Yeah, I think that raises a great point in that the Fed has, some ammo to play with in regards to if things start going sideways, which is
Yeah.
a little different than if you were to look back at 2022 and what, occurred there with when interest rates were low, and you saw the equity market, have a drawdown. And unfortunately, we were starting from very low in regards to yield, and you saw the fixed income market have negative double-digit returns as well. And that leads me into the next part of the yield curve, and that would be the intermediate part of it, right? And
No.
like we just talked about, it's been a pain point for clients' portfolios over the last 3 to 5 years, because quite frankly, the correlation to equities was a lot higher than people anticipated or had hoped, right? A lot of people put the fixed income component in to be a hedge against equity, and that wasn't the case in 2022. And returns were really hard to come by because yields were so low. But it seems like we're entering a new narrative as we look into fixed income, right? So if we look at the 10-year Treasury, we've been hovering around the low fours, pretty steadily now, and we're finally, kicking off some real return, meaning that the yield that you're getting is above what inflation is. So my question is, like, are bonds back in portfolios, and are they finally able to serve as like an income provider and diversifier to equities again? And how are you guys thinking about the intermediate area of the yield curve that isn't so affected by the Federal Reserve?
Yeah, great question. In short, Vanguard's view is yes, bonds are back. You're finally getting the income in your fixed income portfolio that, quite honestly, before 2022, we just weren't getting. Like coming off of the GFC and then following COVID, interest rates were zero bound, and that made it really difficult, to get some real meaningful returns out of fixed income. And when you think about the unexpected inflation that we experienced as a result of like COVID from supply chain disruption and sort of the stimulus, like what resulted was just the inflation was a lot higher than a lot of people were anticipating. And inflation is ultimately the Achilles heel of the fixed income. And so in many ways, 2022 was like a combination of like a lot of different things that formed this perfect storm that really made it a challenging year for most parts of fixed income, unless you're maybe talking about you having some inflation protection in there. And like I think that's helpful context. And you're absolutely right. Like the market reset following 2022. yields are generationally higher. We haven't seen yields like these in quite some time. And like why that's important is like higher yields are going to serve as a cushion against, hey, if inflation comes back again and maybe the Fed needs to pivot and raise interest rates, you're not going to see the same level of sell-off in fixed income that you saw previously, because now you're actually getting some income to help offset some of the that price movement. But also like higher starting yields in fixed income are predictive of like the return that you can expect going forward. There's a high relationship between that. And what I often think about and talk to a lot of clients about is when looking at their portfolios, what has happened historically is because you weren't able to get meaningful yield, people had to really lean into credit following the GFC. And nowadays, what I often tell people is like, what you're getting in treasuries is what you were able to get in high yield just a few years ago. And sort of the implication behind that is you don't need to lean into credit as much, particularly in the high yield, riskier portions of the market. And because of that, you can have a portfolio that's going to provide some meaningful ballast to equity uncertainty. And what we've seen throughout history is, hey, the correlations between stocks and bonds over the short term, they can fluctuate between positive and negative, and we've seen that recently. But like longer term, right? If we're talking like 2, 3, 4, 5 years, there's definitely a negative correlation that we've seen between equities and stocks. And given that yields are a lot higher, we anticipate that relationship to hold going forward as well.
I love the risk reward aspect that you brought in regards to higher yields and in regards to treasuries and credit. And I would even take it a step further into the equity side of the house. And a lot of what we tell our clients is, back in 22 and 23, when I would have to run like Monte Carlo simulations for pension plans and endowments and foundations that had a target rate of return, when you had 1% yield, you had to have so much more exposure into equities to get your targeted rate of return than you do today. So while it's been a very painful ride to get back up to probably a more normalized 10-year treasury of around 4% and a semi-what upward sloping yield curve, it actually is now giving clients the opportunity to probably have a more appropriate overall asset allocation between equity and fixed income to achieve the overall target rate of return that they're looking for. So it's been painful, and I think it also allows clients that have ridden this equity like ride, right? A lot of these baby boomers that are now starting to get into retirement, like let's readjust this portfolio and look as to how much equity exposure that we really do need and what we can generate on the fixed income side. So while it's been painful, I think it also provides an opportunity in regards to overall portfolio management and portfolio risk optimization.
Absolutely, and that's why, like, again, like putting like any particular like client needs to decide for a second, like when our active fixed income thinks about like where along the yield curve is the most attractive, it is going back to your point around like the intermediate portion of the curve, providing that nice risk return profile where you're able to lock in these yields. So even if the Fed cuts rates, like you're getting some meaningful yields on a go forward basis. But even if the Fed cuts rates, like you're also going to get the benefit of capital appreciation on your bonds. And then you can flip it the other way because yields are a lot higher now. If the Fed decides we need to increase rates, like you're getting the income to offset sort of the negative losses that you could potentially see in fixed income. So from our perspective, it really serves as a nice like risk reward trade-off in that in that intermediate portion of the curve.
Yeah, and we know that everything can't always, be great in regards to higher rates. And one thing that is a downside of higher rates is we hear a lot in consumers and clients and in DC is it also leads to higher mortgage rates, right? And that's been something on the longer end of the curve, right? Mortgage rates have been a lot higher than what people locked in 2020, 22. And I think it's important that we remind clients of just because the Fed or Reserve may be cutting interest rates on the short end, that doesn't have a direct impact as to what happens on the long end of the curve. So what does Vanguard think needs to happen if to get these mortgage rates, the 30-year mortgage rate or the 15-year mortgage rate, to come down, and what would that take, and what would the effect be on all market, if anything, and the consumers, what ends up in their pocket?
Yeah, there's I think there's a lot of different things out there that try to touch on this, ranging from like limiting institutional buyers, to last year we heard a lot about like 50-year mortgages, and so I think there's a lot there from like just a policy standpoint that could be implemented to help this. There's also just the fundamental like supply and demand of housing in the U.S. That's going to be a large driver of the affordability going forward. But like if I just think about like going back to the Fed and like how much can they truly influence, like you're spot on, right? Like that long end of the curve, right? When we're looking at like the 10-year, which is the part of the curve that's going to be most highly correlated with mortgage rates, like that's a part of the market where the Fed has some really strong impact on the short end of the curve. But when you start getting to like the 10-year and beyond, like the impact that the Fed policy has tends to be closer to almost like half of the equation. The other things that's ultimately going to dictate, where rates settle in the long end of the curve is just around like, hey, what are the long-term growth expectation and inflation expectations that's out there? What is the Treasury market doing in terms of like its issuance? Are they shifting more towards issuing long-term bonds, or is it more on sort of the short end? So it's almost like the supply and demand on that back end of the curve, which again, if you've got a lot of foreign demand that could potentially be falling off, which we don't think is going to be a huge driver of like what happens on the longer end of the curve. But like those are all factors that's going to influence where the 10-year ultimately falls outside of just like direct Fed impact. And so ultimately, like what needs to happen to be able to like bring that in, and it's all about like the Fed and the Treasury working together to create an environment that market participants think is stable and
Sure.
there's a lot more certainty around. And right now, there's just a lot of uncertainty around things given the concerns around deficit. So I think solving for that certainty is going to be a huge driver in helping potentially bring down those long end of the curve.
Yeah, there's a lot of moving parts when it comes. There's no simple answer, as we've learned. And so I think we've done a good job highlighting the equity piece of a portfolio, the fixed income, and then the last piece that's become more prevalent over the past decade would be the private side of the house. And I think it's a good segue, as we just were talking about. Fixed income has historically served as the equity diversifier, something to help protect portfolios during a drawdown in the equity market. But now that private investments are becoming a lot more accessible to the end wealth management client, right? They've been around forever for pension and endowments and foundations and things of that nature, but now they're becoming a lot more accessible for wealth management clients. How does Vanguard think about utilizing private investments within the overlay of an overall portfolio, whether it be for downside protection, income, and potentially enhanced returns? And what are some of the key questions that you think clients should be asking when considering private investments?
Yeah, our view is like we believe that private market, whether you're talking about equity or private credit, absolutely have a role to play in portfolios. And you touched on some of that, whether that's income, diversification. And what we would say is like a lot of that diversification benefit just has to be attributed to the fact that just the private market is huge. And getting exposure to different parts of the market that like you can't necessarily get through public indices is going to be great from a diversification perspective. But there are trade-offs, right? Like, a lot of times people will talk about, hey, look, the higher expected returns or historical returns. And I think the one thing that people need to be mindful of is a lot of times people will throw these numbers out there, but like, let's take private credit, for example. There is no real like private credit index that like you could buy, right? Like when you talk about private credit, I think a lot of times people think about it as these like monolithic parts of the market. And quite honestly, there's very different segments or strategies within the private credit space, whether that's direct lending to distressed debt. So, and all of them are going to have different like risk and reward trade-offs. And so when we think about it, I think the trade-offs ultimately come down to a few main things. One, private markets are generally going to be a lot less liquid, a lot less transparent. You're going to be seeing a lot higher fees. If you were thinking about, hey, we're talking about 10 basis points of maybe expense ratios and like index equities, well, like, private credit, private equity, you're talking about something that's going to be well north of, 100 basis points at least. And so, right, like the fees are considerably higher there. Also, like the fee structure can be a little bit more complex. But also just like manager selection is absolutely crucial. Like, we would say manager selection is really important, even in the public space. But when you're talking about the private space, I would say like it's even more amplified from that perspective. And while like particularly in private credit, it really hasn't been around quite as long as you would say like private equity. But what we've seen is it's been a really nice benign period for private credit. It really hasn't gone through much of a market turmoil quite yet. So the history is a little bit limited. But like what you should expect to see, particularly as you see a lot more money flowing into the space, is you're going to have some pretty wide divergence in terms of managers. And that's where I think doing the due diligence and having the conviction in the managers can be really important. But ultimately, like if we just take a step back, like, let's also think about it from the portfolio level. I just mentioned that these things can be very illiquid. Well, if these things are very liquid, it's really important to think about how are you funding the position in your portfolio. How much should you allocate? And like, again, like how much conviction do you have in the underlying manager? Because a lot of these strategies, like you can't just go in and out of them very quickly. Like it can take some time if you decide like, hey, maybe you wanted to pivot from these particular strategies. And then also just from a risk characteristics, particularly private credit, it's going to be more akin to what you see in high yield and the bank loan market than it is what you see for treasuries. So if you're funding, say, this private credit position from treasuries, that's going to have very drastic impact on portfolio level impact for clients. So I would say, again, how are you funding these positions? How much do you want to allocate? And the overall conviction level behind these managers are going to be really critical. And then also just the amount of due diligence that's going to be required to stay on top of these strategies are all really important considerations for anyone considering these strategies.
Yeah, and I would add, to those points, which we would agree wholeheartedly on, is right for clients that may come into a sum of money, whether it be from a business liquidation or an inheritance or something, right? The ability to be patient in deploying capital in the private markets, I think, is very important, right? As you want to diversify across vintage years or the year that the fund is starting.
Absolutely.
Right. So all of those key parts like manager selection, absolutely. Diversification across from it, and then also diversification across vintage years to make sure you're having that diversification, but also it helps from a cash flow perspective as well. So a lot of times, right, you get this large lump sum and you're excited to get it put to work, and being patient sometimes is the best thing that you can do there. And in regards to being patient, I think this will help round out the conversation. And when we were prepping for this call, I think we both agreed that, in sum, our base case for 2026 is that we don't see a recession, but neither of us would be shocked if we saw an intra-year, 10% drawdown. And I think one of the biggest keys for clients to stay disciplined and invested and stick with the plan that they've set forth is to understand expectations, right? And going into a year. And so if we want to be shocked if we saw, a 10%, drawdown into a year, what would you see as some of the headline news or things that would happen in the economy or geopolitical that would cause that intra-year drawdown?
Yeah, it's a great question. And I'm definitely going to hit on it. I think one thing that's really important and what we've seen in our data is like normal given year, a 10% drawdown. I think our expectations would be somewhere around like close to a 20% probability. Now that obviously increases when you're talking about parts of the market that are overvalued. Like you just need a little bit of a shock that where you start to see some of that volatility creep back up. And so from our perspective, one of the biggest risks that we see, particularly with U.S. markets, and we spent a lot of time talking about it on this call, is just around the AI optimism. And so if we start to see that optimism fade for whatever reason, whether it's like, hey, the productivity gains that we were anticipating from that, maybe seemed a bit overstated, or like we're starting to see a stalling out of the CapEx cycle. Like those are all really important things to keep an eye out in 2026. And if we think back to 2025, we saw a little bit of this play out too, right? Like, DeepSeek, when that popped up into everyone's news feeds, like, you saw the volatility around the AI stocks around that point in time. And so, that's where, again, we just want to be really mindful of, the price that you pay for things. And when things are priced, again, in some people's view, like to perfection, those are the parts of the market where you're going to start to see a little bit more volatility and could trigger a meaningful pullback.
Yeah, and I think that's where we would both agree that those are the times where you kind of shut your computer from what the market's doing and you get to your plan and what was the plan, and hopefully you had the plan in place that the cash was set aside for whatever that those short-term needs are, and you can be patient and allow the market to come back.
Absolutely.
Well, this was great. I mean, I think we covered, everything from a portfolio optimization standpoint in regards to equities and fixed income and privates. There's obviously a lot of moving parts, and like I said at the beginning, the first 11 trading days of 26 are anything foretelling as to what's going to happen in the rest of the year. I think it's going to be an eventful and an exciting year, and we look forward to seeing how it plays out.
Yeah, absolutely.
Well, thank you. We really appreciate it. And to all of our clients, we look forward to talking to you here soon. And we'll be back with our next Market Pulse in the second half of 2026.